Chapter 8. The Banking Crisis. 1. Historical Overview. Banking crises recur in three forms: single bank collapse, multi-bank runs, or systemic implosions. Early panics were concentrated in central banking nations, England, the Netherlands, Sweden, where usury-based credit made collapse inevitable. The South Sea Bubble of 1720, the Dutch Panic of 1763, and the London crash of 1772 all illustrate how speculative excess, aided by debt monetization, can topple national systems. In America, the first and second banks of the United States deliberately tightened credit to induce depressions. By the late 19th century, engineered boom-bust cycles conditioned the public to accept the Federal Reserve's creation in 1913. Footnote: Central banking crises were not accidents but design features of usury finance. 2. The banking crisis of 2007 to 2008. The repeal of Glass-Steagall in 1999 allowed investment and commercial banks to merge, opening the door to reckless speculation. Government homeownership policies encouraged subprime lending, teaser rates, and lax standards. Credit default swaps exploded to $47 trillion, while collateralized debt obligations, CDOs, bundled toxic mortgages into A rated securities. When housing prices fell 20% in 2008, Lehman Brothers collapsed, triggering global panic. Congress authorized $700 billion under TARP, but Federal Reserve interventions quietly reached $16 to $24 trillion. By 2013, the Fed's balance sheet had grown 500% through quantitative easing, a polite term for financial triage on a terminally ill system. Footnote: The 2008 crisis revealed that deregulated finance had become both arsonist and fire brigade. 3. Consequences and Band-Aid reforms. Post-crisis measures such as Dodd-Frank, 2010, and Basel III mandated stricter capital and mortgage standards. Yet they failed to resolve the root issue: money creation as debt. Debt-based currency demands perpetual growth, but repayment destroys money, forcing new borrowing to keep the economy alive. Thus, austerity and reform only contract credit further. Economists chant growth as mantra because without new loans, money supply evaporates. A debt jubilee with sovereign, interest-free issuance is the only rational solution, but remains heresy within the halls of global finance. Footnote: Regulation can trim excess but cannot reform a system whose lifeblood is perpetual indebtedness. 4. The Great Depression of the 21st century. Globalization and free trade hollowed out Western industry, forcing households to replace lost wages with debt. By the 2000s, $5.67 of private borrowing was required to generate $1 of GDP growth. Rising energy extraction costs, ROA, and looming water scarcity compound the decline. Most ominously, fertility collapse in developed nations ensures long-term demographic contraction. With usury-driven interest payments eroding family structures, population replacement falls below sustainability. The cycle echoes past panics but with existential stakes, not just economic depression, but potential civilizational extinction under debt slavery and demographic decline. Footnote: The current long depression is not cyclical, it is structural, demographic, and terminal unless usury is abolished.